Okay, guys, welcome to Back to Basics, episode 31. If you guys are new here, this is where I take my fiance, soon to be wife Jessica, and teach her how to trade. Again, we're on episode 31, so please go back. There's a playlist on each of our channels that have all of the videos in sequential order. Go catch up. We've already gone through technicals, statistics, fundamentals. We're just wrapping up with different security types now, and then we're going to start going into risk management and actually building a trading plan. And then Jessica's going to start paper trading and showing you guys how that goes. And you can find all of that over at Jessica's channel right here. So if you're watching this on my channel, Jessica's will have the next one over. And if you're watching it on Jess's and you want me rambling at you more, you can come over to my channel. So options contracts. So last time we went over futures. There's as many derivative contracts as you could possibly count, but these are the two big ones. And you got to remember, derivatives contracts are called derivatives because they derive their value off the underlying securities price in some way.
Say that again.
Derivatives are called derivatives because they derive their value based off the underlying price. So for example, in futures, the value of the futures contract is going to be related to what the value of actual gold would be if it's a gold future. So it's a derivative of gold.
Okay.
Just to get that out there. Okay, so last time we said that futures were an obligation between a buyer and a seller to transact at a future date and a future time. We gave the baker and the farmer, and they agree at 3 months from now they're going to trade at this time. Options are more complicated, where the buyer of the option is buying a right to either buy or sell a stock at a certain price in a certain time, whereas the seller of that option is obligated to buy or sell if the buyer exercises his right. And it'll make more in a second, but that's I got from Investopedia, which is a pretty good one. So that is where we have to get all a little existential. You gotta think about the concept behind this concept. And this is a put option, which gives the person who's buying it the right to sell a security at a certain price before a certain time. Now that the person that is selling that option has the obligations. You own Apple, you want to continue to hold Apple, but you're worried over the next 2 or 3 months, maybe they're releasing a new product or they're coming out with earnings or something that could tank the price of Apple, right? You can go to the market and you can say Apple's trading at $100, and you could go to the market and you say, I am buying a contract that is going to give me the right to sell Apple to you at $100, regardless of where the price is in the future. But yeah, so okay, I'm basically buying that insurance policy so that if Apple goes down to $80, right, I can exercise that insurance policy that I bought and sell it to you for $100.
Okay.
Right? So you see how you can protect your portfolio in that way. But you, as the option seller, and both of these people are just traders, just like me and you're not going to do that for free, right? You're going to sell it for a premium, the same way as your insurance premium, right? So what your hope is that so say I'm going to give you $10 to do it, right? Your hope is that you go, okay, I will sell you this insurance for $10, and as long as Apple is above $100, I win. Doesn't matter if it's $100.10 or $100 or $150. Doesn't matter. You get your insurance policy, and that's it.
Okay.
Right? So someone is buying insurance, saying, I'm worried Apple's going to go down. And you're saying, I'm not worried that Apple's going to go down, so I will take the other side of that bet. So what the payoff chart for a put option, it looks like this. Whereas if the instrument is above that price by any amount, you lose a little bit of money. And then if it tanks, that option starts to become valuable. Because you could see that if at the end of this contract, if Apple's trading at $150, I'm not going to sell it to you for $100. And I don't have to, because what I bought from you was the right to do it, not the obligation to do it.
Okay.
So if it's trading at $150 at that point and I want to sell it, I'm not going to sell it to you. I'm going to go sell it to the market.
How long is that option good for?
They go usually 3 months out, but you can go years out. You can go however long you think
Okay.
it is. The further out.
So if you have this option to do it and Apple tanks, like let's say anywhere between when you bought it and when the contract is up, you can get it?
Yep.
Or you have to wait till the contract is ending to see where it's
you
at?
can at any time, and then that contract has value. So if Apple is at $100 and this contract, what they call the strike price, but the price that you can get the shares for, if that's $100, then the value of that contract is just the amount of time that it has left to happen.
Okay.
Basically, real options, guys. I know all the Greeks. I get all that. We're going. There's someone out there who just got mad by me saying that, but basically, you got to think that if the option price and the strike price is the same, or the stock price right now and the strike price is the same, and the contract had 1 day to go, that would be worth less than if it had a year to go. Right. So what the seller is doing is they're just making money every day that goes by that the option remains unlikely to fill. But again, if it tanks to $50 and the guy goes to you and says, all right, I'm selling it to you to $100, you go, okay, and you just have to buy it from him, right? Even though it's half the price, you just have to buy it. Call options. These are probably the most common. So call option gives you the right but not the obligation to buy a stock certain time, certain date, right? So a call option would be, I think Apple's going to go up sometime in the next 3 months. So what I can do is I can go to the market, instead of buying $10,000 worth of Apple stock and making it bet it's going to go up, I can go to the market and I can pay $250 or so for a contract that would go up as much as $100 of Apple stock. So I can take that bet. So basically what I'm doing is I'm changing my bet. Instead of, I think Apple's going to go up at some point and investing $10,000, I'm making a bet for $250 that it's going to go up in the next month or something, right? So what's going to happen is, if I'm right, I'm going to make like 100 to 200 to 300% of my money on that bet. But if I'm right but a day late, I lose it all.
Right.
So it's a way that you can use that as a way to lock in your max risk, because all you're risking is the $250 for that contract. So in some ways, it may be better, instead of going to buy the stock, going to buy the contract, but you're fighting that time decay. And then, so this is what a long call profit graph would be, right? The higher this price goes, the more profit that you get. A short call is the other way. So if you wanted to take the bet of, not that Apple's going to go up, but I just don't think it's going to go under, you see a support area. You say, I don't think it's going to break that support. I don't know if it's going to bounce off it a lot. I just don't think it's going to break that support. You could sell a call option at a price a little bit below that support, and then every day that goes by, you make a little bit of money. So what that P&L graph looks like this, where you've got this profit, but Apple could quadruple in price. You're only going to get that $250 you sold the call for.
Okay.
Right? So you're capping your upside, but you're increasing your downside dramatically. But what you're doing is, it's an easier bet to make. It's easier to say, I think Apple is not going to go down, than I think Apple is going to definitely go up.
Right. Okay. So you make way more money on the long calls.
Right. But it's easier to be right on the short calls. So what a directional trader, they call it, like me, what my P&L graph looks like, my equity curve, is maybe down a bit, flat, down a bit, up big, right? And then, because I'm wrong a bit, and then all of a sudden the thing goes. What a call option or a put option seller equity curve looks like is the exact opposite, where they're right, and then they lose one, and it's going to wipe out a bunch of the times they were right, but they're going to be right way more often because the bet's easier to make.
Right.
It's how I think personally, and this is for you and this is for them, you can trade these, and these are on actual stocks, they're on futures, they're on everything that we've covered. There's options on. It's all about how much you value being right that often, right? I'm okay with being wrong half the time, because I know every now and then I'm going to get one that's going to blow it out of the park, and all I have to do is manage my risk until that happens. There are some people out there that if they're wrong a few times in a row, they go crazy. So they may be weighted to this other side. And that's just because basically the way the market puts in is that most options, it's like 80 to 90% of all options expire worthless. So how are they priced? Again, there is like 6 dimensions to price when it comes to options. It's a really complex math equation. It doesn't matter. We don't need to go into it. But basically just think of an option's price by what's the likelihood that option will be worth something when it expires, right? So there's a couple things that affect that likelihood, right? The big one is time. If the bet's 2 years out, it's way more likely it's going to occur than if it's 2 days out. The other thing is how much does the stock move? If the stock never moved very much and then all of a sudden it's moving a shit ton, then there's a higher chance that it will be worth something at the end. And that's it. So put options, other side of call options, right? That's the initial example we did. You're basically buying protection on the stock going down. It's also a way you could short securities that you may not be able to find borrows for.
Long options and put options.
Call options and put options.
Oh, okay.
So call is basically you're calling the stock to you from the other person.
Okay.
So you're going to buy the stock from them at this price, and a put options mean you're putting the stock on them at that price. But it's the other way around, right? So if you thought a company was going to go up, you could sell a put option, right? And if you think, and this would be your P&L graph, right? Which is that little bit for a very wide range of price, and then the starting to decrease after that, right? And same with if you bought a put option, if the price remained the same or went up, your put is worthless. But if the stock tanks, you make way more money on the downside. So it's just the flip. How are they priced? Same way, right? What's the likelihood that this contract will have value at the end of all of this? Make sense? And then the next is, so we're talked about time decay, right? Already, the longer the option is till it expires,
the more it's worth.
The more it's worth.
Gotcha.
And then we talked about selling options already. I went through all of this already, but this is just kind of the baby pool example for anyone who hasn't gotten it. There's 2 ways to do a baby pool. Imagine everyone goes in and says, I'm going to pay $10 to bet that she's going to have a baby on this date. And if I'm right, I'll make $100, right? Someone could go in and said, I'm going to bet on all the other days, right? So all I have to do is have her not give birth on one of my days. Right? I'll bet every other day that she won't, and then I'll make less money.
That's a good example.
Okay, it's how it was explained to me, right? It's like instead of betting on something occurring, it's easier to bet on something not occurring, right?
Yeah, that makes sense.
And then you can do, we won't go too much into these, but this is what happens if you did calls and puts. So a long straddle
on the same stock.
So what if your bet was, I think Apple is either going to go up huge or down huge in the near future, but I don't know which one.
Okay.
You can buy a call and a put, and the P&L graph looks like this. So if Apple is anywhere within this price, you lose money. But if Apple goes up a bunch, you make money. Or if Apple goes down a bunch, you make money.
Oh, that's kind of nifty.
And then you can flip that, and you could say, I think Apple is going to remain between $120 and $80 for the next 3 months. And if you're right, anywhere within that price, you make money. And if it goes, right? That's a straddle. This is a butterfly. Basically, you decrease the amount of money you're going to make, but you increase it out in time. And this one has a max profit and a max loss. And you can do these not only, which is important to note, but you can do these not only at the current price, but you could do it at another price. So say Apple's trading at $100 and you get real good at trading. You look at the chart, you say, I think that's going to go up to $150 and then stop. You could write one of these straddles where this point right here is $150. So if it moves up to $150 and then peters out, you make a whole bunch of profit, because not only were you right on direction, you were right on that it wouldn't go higher, so you can sell them for that price. And then every day that goes by that it moves towards your bet, you make money, just as that slow time decay. But again, these are these are advanced, and there's like a million more that you can do with them. There's all kinds of combination of buying and selling both calls and puts on the same price. You can come up with all kinds of craziness. But I just wanted to show you the basic examples and didn't just think if you were going to have the if this was something you'd gravitate towards. We could go over it more, but that's a basic understanding of futures and options. So again, if you enjoyed this, come check us out. Any more questions before we go? No? All right. See you guys next time.